I lost a ton of money. I made a ton of stupid mistakes when I started investing in real estate, and I want to share it with you to save you a ton of time and money. Every investor makes mistakes and loses money at some point in their journey. However, if I can prevent you from making one stupid mistake like the one I'm about to share with you, I can save you tens of thousands of dollars. But most importantly, I can save you a ton of time and mental pain. So in today's video, I'm going to share with you some of the biggest investing mistakes that I've ever made in my investing journey. And as embarrassed as I am to share this with you, I want to be transparent with you with my investing journey so that I can help you some way, shape, or form in your journey. And if I help you in any way, then this video is totally worth it. And if you found this video helpful in any way, please smash that like button. Now, the first biggest mistake was spending $10,000 on a futures trading course, which is like, and I realized it wasn't for me, okay? I realized that after I quit engineering and then I really traded in for another job, which was day trading, and that wasn't what I was looking for. Highly stressed. If you're looking for more education and a coach, please ask yourself, is this coach trustworthy? Is this coach living a life that you desire? Are they successful with what they're doing? If they're teaching you, say, how to day trade, are they day trading successfully, or are they making a lot more money selling you courses? Or if you have a financial advisor and they're selling you a bunch of mutual funds and these index funds, ask yourself, is this financial advisor actually successful with investing? Or are they making a lot more money through commissions by selling these funds? The second biggest mistake I've ever done was letting my money sit in guaranteed investment certificates. So back in the day, I opened my tax-free savings account. I opened a registered retirement savings plan. I did all the right things, but what I did is I actually started plunking money in and then putting it into guaranteed investment certificates. So rather than taking the time, learning about investing, getting educated, I just took the lazy path and decide, hey, I'm gonna put in GIC so that I could collect like more than 1.5% interest. So that was a big fat waste of time. So please, if you have cash in your TFSA, in your RSPs, please start investing it. Investing in either ETFs. Maybe you don't like doing research on your stocks, even though it doesn't take a lot of time. Maybe you're just like too lazy and you're like, I'm cool with investing in like ETFs, then go ahead, at least invest in ETFs that track the index, like the S&P 500 or the NASDAQ. But please just invest your money. Or you're like me, you love choosing individual companies because you have more confidence, clarity, conviction, investing in individual high quality companies that grow their revenue, grow their cash flow, grow their earnings, grow their profit margin, has a ton of cash, low debt, then those are great fundamental companies that grow and make a lot of dough, and then you just buy them undervalued. So bottom line, if you have cash in your TFSA, RSPs, please invest in the money other than guaranteed investment certificates, because you are actually losing money every single year. Okay, the third biggest mistake I've made was when I started investing in stocks, there was a ton of books about value investing. A lot of the metrics that they were stressing on was low price per earnings ratio, which is comparing a stock A versus stock B. So it's like you're going to the grocery store and you're looking at cherries. One day it's like $8.99 per pound, and another day it's $1.99 per pound. Then you know, obviously the $1.99 is a better price than the $8.99. So that's the same with having a low PE ratio. You're looking for a cheaper stock. But in reality, you can't just focus on a couple metrics. Just because a stock has low PE ratio, it could actually be a value trap. Maybe it has crappy revenue growth. Maybe it has a ton of debt. Maybe its profit margins is like, but all I'm trying to get at is that I made the biggest newbie mistake was just looking at low PE ratio stocks and completely writing off any stock that had a PE ratio over 15. And that meant selling all my Google stocks, selling my Microsoft stocks, thinking my Lululemon stocks were overvalued. I sold them all, which is one of the biggest mistakes of my life. So please, if you're looking at stocks, don't just look at a couple metrics and completely being hyper focused on it and just say it's overvalued or undervalued. Please, if you're looking at individual stocks, don't always look at the PE ratio. Investing in stocks is more of an art than a science. There's definitely hard metrics that you could look at, like PE ratio, price per sales ratio, all those metrics, but don't be completely focused on metrics. There's an art to the company, meaning who's the CEO, how are they executing, what's their management team. So there's an art plus a science to investing in stocks. So bottom line, don't completely be hyper focused on metrics like just a PE ratio. Now, the fourth biggest mistake is having no goals. Have you ever opened your TFSA and asked yourself, what is your end goal with your tax-free savings account? What is your end goal with your RRSPs? So maybe your TFSA is like something that you want for a 10-year time frame. So that will dictate the different types of investments that you make because you have a 10-year long-term buy and hold. So maybe like a stock like Tesla or Amazon, Microsoft, or Google, when you buy them at undervalued price, you just like buy it and then forget it because you have a 10-year time frame. Versus if you had an RSP, you might be a first-time home buyer and you're like, I'm going to use that money as a down payment for my first property. Well, then that money, the type of investments you make in an RSP must be super ultra safe. So I actually think if you need that money in less than 3 years, you definitely do not want to invest in stocks. So your RSPs would dictate the type of investments you make because your goal is to have a down payment for your home. So that means you don't want to invest in stocks in your RSPs. So what is your end goal with each of your registered accounts? Because that will dictate the different types of investments that you make. So please ask yourself, what is your goal with your RSPs? What is your goal with your LIRA? Because that will dictate what type of investments you make in each of those accounts. The fifth biggest mistake is being stuck on price. Okay, how many of you are doing this? Oh my God, Lululemon went down 2%. Oh my God, Lululemon went down 5% last week. And you're like, see, the problem with that thinking is that Lululemon, the company doesn't care what it does every single day. The company is just doing its thing, selling its products. When it drops 2%, doesn't mean Lululemon, the company, has done something horrible that deserves to drop 2% in that day. Probably not. It just means that the stock market is a lot of buyers and a lot of sellers and they're just trading. And sometimes there's not enough volume and the stocks drop. Maybe sometimes the volume increases. There's a lot of buying, so the price goes up, but doesn't reflect the true value of a company in the short term. In the long term, the stock price will reflect the true value of the company, but in the short term, it's like, no way, Jose. The short term makes no sense. So please stop looking at your stock charts every single day. If you are a long-term investor, what does it really matter what it does next week or the next quarter? So if you're ever in doubt, zoom out, chill out, stay invested in a high quality company and just buy it when it's cheap. The next biggest mistake I've seen, and this is something I've actually not done, but I've observed over and over again, I have to let you know, please stop chasing premiums. So this has to do with selling put contracts. I've seen so many people sell naked puts, which is saying you don't have the cash to buy 100 shares of a stock, but you're able to sell a put contract, a naked put contract on a meme stock, because guess what? Meme stocks have a ton of volatility, so they have awesome premiums, which is awesome in your pocket, but in the end, you're owning a pretty crappy stock, a pretty stock. So please avoid AMC, GameStop, BlackBerry. Those are all meme stocks. As much as there's a ton of volatility, and yes, there are premiums, they are in the end crappy companies. And when you get stuck with a crappy company, you're going to lose a ton of money in the long run. Rule number one, if you sell puts, please avoid meme stocks. Please, please, please just avoid meme stocks. You will thank me at the end of the day because you will not want to own them. So bottom line, I want to give you some actionable tips. If you're looking to invest in individual stocks and you have goals with each of your accounts, like your TFSA, your RSP, and your LIRAs, your RESPs, please, in the end, just buy individual companies that you've researched or buy ETFs, high quality ETFs, and invest in the long term. In the end, if you buy a company, a stock that's undervalued, you buy it at a cheap price, in the stock market, hold it for the long term, you will do fine. Like buying FANG stocks when it's undervalued is like a no-brainer. Anyways, I hope you found this video super helpful. If so, give me a thumbs up. And if you haven't subscribed, why not? I am a Canadian YouTuber that loves talking about stocks and real estate to help you grow multiple streams of income, build your wealth, and design your ideal life. Anyways, I hope to see you in the next video.